Hi, everyone. This is Jason Burak of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's a second-generation money manager. He's author of the new book, The Intentional Legacy, which is available now on audiobooks, a great self-help book. I recommend it if you are looking for solutions maybe with problems that are happening in your life, and you want to see someone who's actually overcome them and achieved some different versions of success. He's the CEO of McAlvany Financial and the McAlvany Group of Companies, and he hosts one of my favorite shows, probably the only show I listen to every single week, including the Richard Duncan episode, which is rare for me, with Richard Duncan, David McAlvany, and the McAlvany Weekly Commentary. So, David McAlvany, thank you for joining me again.
Jason, good to be back with you. Thanks for a generous introduction.
Now, David, I want to ask you about central bank balance sheets. So according to Dr. Harold Malmgren, he put out this Twitter graph. I'm not sure which source he had it from, but central banks have, according to this graph he put on, including the People's Bank of China, their balance sheet, 45% of global GDP on their balance sheet. And yet the European Central Bank, the Bank of Japan, the Federal Reserve are all telling us that they're going to be able to magically reduce their balance sheets and there's going to be a smooth landing, no stock market crash. What are your views on this? Do you think that they can actually meaningfully reduce their balance sheets without something big breaking in the asset markets, the credit markets, or the real economy?
Well, I guess the first question is, was there a meaningful impact from the expansion of their balance sheets? And I think if you look at the asset markets, the financial markets, there's definitely been an impact there. For the longest time, there was little impact at all into the real economy, and it was just strictly with asset price inflation. So it seems fairly logical to me that if expansion of the balance sheets boosts asset prices, then contraction of the balance sheets probably changes the supply dynamics, and it may impact price. So I guess the real question then would be, is there going to be sufficient demand from other parties to step in and take care of that new supply of financial assets that they theoretically are going to liquidate? I suspect, as you do, that it's going to be much more challenging to do so, and that they're going to run into problems as they see the impact in the asset prices of the stock market, the bond market, maybe even select commodities where they get concerned.
Now, the Federal Reserve, before Janet Yellen left, she was talking about reducing the balance sheet. But when I looked at the St. Louis Federal Reserve assets, they hadn't even been reduced by $100 billion before, I guess, the dollar index about a couple weeks ago. The dollar index was about to break 88 support levels. And then all of a sudden, magically, I checked the St. Louis Federal Reserve website, and the balance sheet starts to expand again. So, do you think this is all talk, or do you think the new Federal Reserve Chairman, Jerome J. Powell, do you think he's going to eliminate this Fed put that's been going on for a while?
I think the interesting thing is that we've had a bit of a regime change in the sense that, for the last 4 or 5 years, it really did matter everything that was done and everything that was spoken from your various Fed chiefs. So it could be St. Louis, could be San Francisco, could be New York, and all of them were having an impact. They would speak, and there was a market impact. The regime change is that now you've got, very important, what happens with the whole cadre of Trump people. So what if something comes out that's related to trade and tariffs? What if it's the latest attack on Amazon? You begin to see not just an impact into the financial markets, but also really a sensitivity to what the implications may be into the larger economy. And that is almost like pulling the carpet out from underneath the folks at the Fed. If the Fed really wants to reduce its balance sheet, they're going to have to be very sensitive to sort of putting their finger to the wind and seeing what they can and can't do as it gets much more complicated by politics. So last 16, 18 months have really moved us into a really interesting place, and I'm interested to see.
The other things I've seen, David, the last couple of years is the Fed hasn't been the one doing the majority of the QE. It's been the Bank of Japan, the European Central Bank, and the People's Bank of China who have been doing the majority of the money and credit creation. And, that's boosted up the asset markets. We've seen the Bank of Japan recently in the last couple of months say they want to reduce their balance sheet too and slow down QE. But then when yields started to spike in the Japanese bond market, they were back in there buying. The European Central Bank has said that they wanted to reduce the amount of QE, and maybe for a short amount of time they did. But then recently, in the last week or two, I think they doubled the amount of QE that they were doing after they had cut. There was a panic restoration of it. So it seems, that this central banker talk of getting out of there, stopping it, it just seems it's all talk now. Very little action. And the market seemed to believe it at this point. But the U.S. has really benefited, even though they haven't done QE, a lot of the liquidity from the other central banks in those three main economies that I mentioned seems to have come to the U.S. in the stock market, the bond market, and the real estate market.
Yeah, it seems to me the earlier point is very critical, that as soon as there is a meaningful change in asset prices, they have to reconsider what it is they're doing, shrinking the balance sheets, tightening liquidity, et cetera, et cetera. So we've seen some changes in LIBOR and classic tightening, and then all of a sudden in indications of risk, and they back away. So it's a fascinating time to be an investor or an analyst or just an observer from the sidelines. You're exactly right. Central bank activity it started out being a U.S. project. We passed the baton to the ECB. ECB maintained it, and the Bank of Japan joined into the fray. And there is a meaningful impact. The big deal is when rates begin to rise and they can't do anything to quell the rise, the big deal is begin to see a radical repricing of assets. I mean, where bonds can trade 20-30% lower. And most people consider fixed income to be relatively stable and not particularly volatile. But you could see tons of volatility in the bond market. And we're not talking about sort of risky issues. And same in the stock market. You raise your hurdle rate by 150, 200 basis points, and in a very leveraged corporate environment, you're going to see an impact to operations, and you're also going to see an impact into valuations of those companies, where all of a sudden Wall Street has to look differently at the stock market. So, they can talk about normalization. They can talk about reducing balance sheets. But insofar as rates begin to rise, you're talking about utter chaos in the financial markets. And you're already dealing with an incredibly uncomfortable, obtuse, unstable financial structure. This is the context that we're in, and we're pretending that it's all behind us and the economy is on the mend, and there's going to be more fiscal spending and there's tax cuts, and so the supply siders are doing their jig. But there's really a lot of instability underneath the system, and those little incremental increases in interest rates begin to reveal the weakness, and that's, I think, when you see sort of the panic within the central bank community, because they realize that best laid plans of mice and men, maybe that's Freudian, the best laid plans of mice and men sometimes go astray.
I was going to add to your points there that we haven't really seen a bond bear market in over 30 years. We've had a bond bull market since Paul Volcker jacked up rates, around 1980. So there's been a bond bull market since then, pretty much. And so, a lot of people who have been trading on Wall Street haven't seen a bond bear market, despite, rate hikes, periodic times of rate hikes, how Alan Greenspan was temporarily raising interest rates before the housing bubble pricked. But I think an important thing to note here is that I don't see central banks being able to get away with one thing, let alone both things. They're talking as if, David, that they can raise rates, at least the Federal Reserve is, that they can raise rates and reduce their balance sheet, both of these things, without breaking something. And so, for them to be able to do one of these things without breaking something is a low probability, but to be able to do both of these things without breaking something in the asset markets, considering how much debt is out there and all the leverage, I think it's very high probability at this point that something will break if they try to do both on a meaningfully.
Well, there's an outside possibility that it's not just something that breaks, but it's everything that breaks. Because this is not wild-eyed speculation. The cost of capital is a meaningful. It's a meaningful reality to the asset markets, to the financial markets, to corporate managers, The cost of capital is a real thing. It's, as you said, it's been coming down since the 1980s, early 1980s, which has allowed for massive expansion and a massive leveraging up of balance sheet assets. Well, what's the impact when the cost of capital begins to increase? I'm not sure it is a breaking of something. It may be a breaking of everything.
So let's talk about the dollar now. So the normal correlation that people are taught, the textbook correlation, is when a central banker raises interest rates, normally that's going to strengthen the currency. But we really haven't seen that with the interest rate hikes for over a year now. The dollar and the dollar index actually has come down more than 10%, although it looks like it may have temporarily bottomed at around 88 and it's having a little rally here. So what are your views on that? With why isn't the dollar strengthening, in your opinion, despite the rate hikes?
Well, this was a part of the conversation and a little bit of a debate that Richard Duncan and I had because, ordinarily that relationship holds, and he was then assuming also that if interest rates are going up and the dollar's going up, then commodity prices should be coming down. And, that's his speculation, that he does believe that to be the case. And on that basis, gold and silver are probably a bad bet, along with a lot of other commodities. But, as you note, interest rates have been coming up. They've been coming up since mid-year 2016, and the U.S. dollar is under pressure. So something is not right, and or maybe it is right in terms of the appraisal and judgment of our foreign creditors as to what is actually happening. Do they trust the Trump administration to hold their interest in mind, or did they hear him very clearly that if we have too much debt, he knows what to do with too much debt. You just default on it. So if you've financed this grand U.S. Ponzi scheme as a foreign creditor, and you have the leader in chief of the United States saying stuff like that, is it a surprise that you begin to see changing relationships as you already have a changed perspective on some of the assets in question, whether it's treasuries or just U.S. dollar-denominated assets in general?
And we know that President Trump and the Treasury Secretary, Steve Mnuchin, do not want a strong dollar. They want a weaker dollar. Now, obviously, they don't want the dollar to crash. They want to, control its decline. But, these rate hikes and talking about something breaking, with President Trump, with these budget deficits. So the projected numbers, I think, are $1.2 trillion budget deficits going forward. President Obama, the last couple of years before he left, delayed a lot of spending and borrowing. So I think the U.S. Treasury in the near future is going to have to raise $1.8 trillion. So do you think the market's looking at this and that's why the dollar's weak despite the interest rate increases? And they're looking at these budget deficits with President Trump. And, President Trump is not a spending cut guy. So he did supply side economics, tax cuts for the private sector are good, but there was no corresponding government cuts in government spending. So do you think that's why then the dollar is getting weak when despite the interest rates are increasing?
Good chance of that. I mean, because now you're just talking about basic math. Somebody looks and says, well, you don't have enough money to pay your bills. And, from a political standpoint, the argument has always been, well, we always have enough money because we'll just increase taxes. And yet you've got a man in office today who that's anathema to him, and he's already made strident efforts to go the opposite direction. So the one sort of ace up your sleeve when you're running massive budget deficits to keep your foreign creditors happy is to say, don't worry. Just because it's this year doesn't mean we can't jack taxes next year and absolutely fleece the man on the street. We've got access to more capital than you can imagine, and we're so below the let's call it the rebellion threshold where people just say enough. Pitchforks and flaming torches. We've had enough of this. We're so below that threshold. The argument would go that we're not going to jeopardize our ability to raise taxes and increase income. You don't have the trend. So the logical conclusion is massive budget deficits and inability or unwillingness to raise taxes for several years. Yes, you should see pressure on the dollar. You absolutely should see pressure on the U.S. dollar. It reflects a rational appraisal by foreigners of what U.S. assets are today.
And for every 1% increase now in interest rates, because the national debt is over $21 trillion now, we're looking at an additional, well, not you and me, David, but the U.S. federal government is an additional $210 billion with a B dollars in interest payments. So that's going to, if interest rates were to go up another 2% or 3%, that's going to totally blow a hole in the government budget. Same thing if the asset prices were to crash and stay there, which is why, if we do have an asset price crash, I don't think it'll be allowed for more than 6 to 12 months because the government needs those capital gains taxes to come in because, 2008, there was a huge hole in the government budget because the capital gains taxes for the asset prices weren't able really to be paid. I think they dropped really quickly, 20% in 2008. So the government has I would say a perverse incentive to intervene in markets and manipulate now. Not only do they own a lot of assets, the Swiss National Bank is a hedge fund. Its shares have gone parabolic. It's publicly traded. I just learned that. Ridiculous stuff. But, there's also the incentive now for the governments and central banks to intervene in the asset markets because that means that they keep their government income and their tax revenue stable.
Well, and just to go back to that point on an increase on the interest component by $200 billion, the leverage in the system is somewhere between 60 and 65 trillion. So when you talk about a 1% increase in interest rates, assuming that has a material effect across all of your credit markets, maybe you're talking about a $400 to $600 billion increase or weight for the whole economy to bear. And so, you are talking about, I know we're getting used to trillions, but you are talking about real money still when you're talking hundreds of billions of dollars. $400 to $600 billion per 1% interest rate increase. That's significant. Certainly as a line item for the federal government, and absolutely for a corporation or an individual if you've got to recalibrate your finances in light of higher interest costs.
I completely agree. There's an enormous, according to, I think, the Bank of International Settlements, there's about 20% of all global corporations that are zombie corporations that can barely pay their interest payments and would be insolvent if interest rates moved higher. So there's that. There's the amount of junk bond debt that's out there. There's the amount of leverage buyouts that have already been done that I would say are very questionable deals. So you brung up the total amount. What's your opinion on this LIBOR spread increasing so much? So I heard some very interesting things on a Michael Pinto interview recently. He said the LIBOR is up almost 8-fold since 2015. So what do you think that could be signaling along with this spike in the VIX that we saw in February?
Classic tightening. It's classic tightening, and you just have to start playing what are the consequences in earnest moving into a tightening cycle. And I think your listeners know how to connect those dots.
Yeah, and surprisingly, the VIX is down a little bit today. Maybe that's because the dollar was strengthening, but the VIX got to, I believe, almost all-time lows at 8 to 10 a share about 4 or 5 months ago. Got to all-time lows, and it was down there for a while because of this leverage short volatility trade that a lot of people who really shouldn't be in that trade were in that trade. It's one of the most overcrowded trades on Wall Street, and now the VIX, it was hovering a lot higher. The VIX is starting to make higher lows. So very interesting what the LIBOR spread spiking so much, and also the VIX are starting to tell us. I think, the new normal, David, is that we're going to see a lot more volatility going forward. We're seeing like whipsaw action in stocks where, we're having 2% moves now daily up and down in the stock market, whereas a couple years ago that was not happening.
I could be wrong, but when you have everyone who has a strong opinion and their opposite opinions, you've got a confused market. And it seems to me like the bulls are certain that we're heading higher. The bears, if there are any, are certain that we're heading lower. And you'll have a sell-off of 500 to 1,000 points, and then a recovery. This is we just saw this. I mean, 1,000-point increase off of yesterday's lows to today's close, and what it suggests, that kind of volatility, the extreme volatility, suggests that you are at a market top, in my opinion. And why? Because you've got these clear, and again, everyone thinks that they see the world accurately, right? I see the world perfectly, and you must be wrong. you've got a clear picture of a bullish trend in the economy, according to some, and therefore the stock market should keep on rocking and rolling in spite of having 9 years with almost no corrections until the one we had earlier this year. But that was healthy, and now we're onward and upward. That was what we would categorically call a healthy correction. Now we're onward and upward. So goes the bullish case. The bearish case is I think, one that is easy to articulate. At least I would articulate that side of the case. And so you have volatility. 1,000 points up, 1,000 points down, 1,000 points up, 1,000 points down. Ultimately, you know what we're going to see, Jason. We're going to grind down. We're going to grind down the general public where they just don't know what to do. They feel like a yo-yo. And at a certain threshold, let's say it's the 200-day moving average for the S&P, you break very much below that. And the people that matter, money managers, intelligent, large investors who are saying, I know what this means. They're watching, and they'll cut their risk considerably. They will cut their risk back very considerably. So as we're sort of grinding sideways in 1,000-point rallies and declines, people are watching the moving averages, people are watching for a technical break, and people are getting tired. They're actually getting ground down as time goes on. This kind of volatility is not healthy for the bull case because you need a clear sense of what tomorrow will bring for there to be more and more people jumping on the bandwagon. And all this adds is confusion. This kind of volatility adds confusion to that.
Yeah, I agree. And we're also hearing the Federal Reserve, their plan as of right now is starting in October to take $50 billion per month in liquidity out of asset markets and their purchasing and reinvestment. So we'll have to see how much of that they do and if they actually do it, because like we've discussed earlier, talk is cheap with the Fed. They have a track record of being wrong. They have a long track record of not doing what they say. So we'll have to see if they actually do that or not going forward. But, you know, if these central banks are at least temporarily going to take a good amount of liquidity out, then I can't really see a bullish case for the stock markets to go higher. So we'll have to see if they actually do what they say.
You're right. No, I mean it comes down to, you know, liquidity theory of asset prices. If we have excess liquidity, prices will go higher, and if you do have a tightening of the credit markets, then it's like taking the oxygen out of a room. You know, you can't sustain life in a room that has no oxygen, and that's the nature of liquidity to asset prices.
So let's talk about someone who you recently had a full McAlvany Weekly Commentary on. That's Warren Buffett. So in your opinion, why is the investor who made billions off market inefficiencies, picking out individual stocks, making and winning a bet with a hedge fund manager that indexing will outperform the best hedge funds?
Well, I think it's kind of a two-step. One, he says that look at the whole world of managed money. It has not, since 2008, held up to an exchange-traded fund or an index fund. So what are you getting? Not much for what you're paying for. And that's the first conclusion. The next step is Berkshire Hathaway has outperformed those index funds. So I mean, it's a little bit self-serving the way he's set it up. Is the bet was not really about whether indexing is better than a hedge fund, because in essence, if that were the case that he's trying to make, why doesn't Berkshire Hathaway just quit what it's doing in terms of acquiring new companies and take all the assets and put it in the S&P 500 and just join that bandwagon, right? Is he proposing that he does that with Berkshire Hathaway assets? I don't think so. I think the point is really arrows pointed at me if I'm Warren Buffett. Look at me, I'm special, very successful, and by the way, the best hedge funds can't touch this. The ETFs, which are better than the hedge funds, can't touch this. So it's really kind of an. I took the last read through the annual report as a little bit of an ego trip, as he sort of did his victory laps and said, you know, yes, indexing is better, but I'm better still.
Well, I mean, Berkshire Hathaway is so large at this point that they are almost an index fund all by themselves, because he can't buy small companies anymore and that can grow, you know, earnings and revenues 50% every year, every couple of years. He can't do that without buying up entire companies, and those won't move the needle for him. So he has to go and make large purchases, which means is he's almost like an index fund, although, obviously there's active management there. But I think his point about hedge fund managers, the fees. So there are a lot of skilled hedge fund managers out there. The problem is the fees for a lot of the industry for hedge funds for over a decade now have been drastically overcharging. And the fees structure of hedge funds are so high now that they make it, basically you're kind of ahead of the curve just indexing. And the other thing, and I'm not sure if I've heard anyone mention this, is I think, Buffett is so tied in now with his political connections that he realized that the central bankers, especially in 2008, were going to reflate the entire system. So he knew that he would win a bet with indexing because the central bankers were going to have like a put for a long time, and they were just going to go in there and reflate like the major stock market indices. And, if in hindsight, David, if you would have told me now back then what the central bankers were going to do, of course, then it probably would have been a smart bet to go and buy, some call options on the Dow or the S&P 500 or just index, because the central bankers were going to make sure it went up a lot. But, back then, I think no one knew that the central bankers were going to put well over tens of trillions of dollars in easy money and credit into asset markets to make sure the asset prices went up through the roof.
It took an outsized imagination to foresee what they did. Never been done in the history of mankind, and tough to calculate, what their logic would have been. But, I agree with you on the fees. Wall Street has gotten away with something quite interesting. I ran into a group not long ago that charges 2 and 80 on their fees,
Whoa.
2% and 80% of all profits. And I thought, wow, it's interesting that their investors don't recognize that as highway robbery. 2 and 20 all of a sudden looks a lot better. But 2 and 20, what is that really? It's gambling with other people's money with a huge return for the person who's doing the gambling. Just philosophically, I'm not opposed to making money, but philosophically, we chose when we set up our fund, it's a tactical short fund, specifically short, with Doug Noland, we chose to do a 1% flat fee, no performance related, because we're looking for long-term partnership, whether it's with an institution, a pension fund, an insurance company, a high net worth individual, where if they have a long equity portfolio, we want something that rides alongside what they do indefinitely. And they're not measuring us, I'm like, we're just getting eaten alive by these fees. We do a great job. We do what we're supposed to do, but it's with a modest fee, 1%. And actually what you're getting is hedge fund management, but without the fee structure on the short side of the market, which is one of the most grueling and challenging places to manage. So very unique. I think we'll have success with that because of a recognition with what Berkshire has acknowledged, which you did too. Fees are a big deal. So add value, but do it at a reasonable price, and then you can consider long-term, mutually beneficial partnerships.
I also think, David, that eventually indexing will blow up because it is relying on this central banker put and no skill at all that the markets will go higher. So, it's betting that the central bankers will continue to reflate and will not allow the asset prices to stay down, and that doesn't sound like a skilled investment strategy. The other thing about Berkshire Hathaway that I wanted to bring up that you mentioned in that episode of the McAlvany Weekly Commentary, and I think our listeners should definitely listen to that, was the record hoard of cash that Berkshire Hathaway has. I didn't know that. They have $110 billion in cash. So why do you think Warren Buffett is talking up stocks but hoarding cash, so much cash then?
Well, the reality is Berkshire Hathaway has never avoided a 40 to 60% decline when the stock market has sold off in similar fashion. So, he knows that, there's oscillation back and forth even with the best quality companies because sometimes the market freaks out and sells you for no good reason. And so even if he is the best quality company on the planet, the best consortium of companies, he's going to suffer. What's in it for him is being able to buy some assets very cheaply, and he's made some great acquisitions through time. When you hoard cash, it's generally because you think that asset prices are too rich and you don't want to overpay. Kind of rule number one in terms of buying an asset, can I make money based on the purchase price? Am I buying it right? And hoarding $110 billion in cash would suggest to me that Berkshire Hathaway as a group, and perhaps Warren and Charlie are together saying, things are a little rich. I don't think I'm going to buy anything right now. That doesn't mean I'm not going to. He'll back up the truck with $110 billion. He's not afraid of spending money, but he wants to do it when he can get a decent deal. And since there's no deals, he's hoarding.
I hope you're enjoying our interview with David McAlvany. We'll be right back after a word from our sponsor.
Do you work out routinely and eat healthy almost all the time? If you eat paleo or vegan or work out routinely, you may be eligible to save up to 33% off on your life insurance thanks to Health IQ. Health IQ is a venture capital-backed, big data technology life insurance company that offers customers life insurance at special rates by using the latest technologies. For more information, please go to healthiq.com/WS4MS. That's healthiq.com/WS4MS. Yeah, I think it's smart for people out there to have a cash position. I've been saying this for a while just in case there is a market crash or huge correction, and that cash is a good diversification strategy. It gives you optionality and options to go and buy assets that go on sale at fire sale prices. The person who had a good amount of cash in 2008 was the person who could go and buy, real estate for pennies on the dollar for a short amount of time, really quality stuff or quality stocks. But right now we're looking at, David, some of these large cap stocks like Campbell Soup has negative revenue growth. Their revenue is actually shrinking, and it's trading at a 25 times earnings multiple because people are so desperate for a 3% dividend yield. Obviously there's tons of other large cap dividend stocks exactly like that, so I don't want to single them out completely, but this is the market conditions we're in, where people are actually willing to pay those valuations for a company with, that's actually shrinking.
Yeah, the consequence of central banks putting so much money into the marketplace is that they've displaced where assets would have gone. They've displaced where investor dollars would have gone and forced them to search for yield, forced them to search for some form of returns, and it's skinnied up returns all over the planet. So, return to normalcy, we'll see it eventually. But we're at war. I don't know if you know that, but we're at war. The bulls have no intention of letting go of a 9-year bull trend. And there is going to be all kinds of interventions, whether it's just your big players, protecting their interests. I mean, this was very common. In the 1920s, your big players would rig the markets all the time. And I don't think anything's changed through time. And I'm not even sure it's a conspiracy. It's just, look, if you can, you will. And now you actually get a little central bank liquidity virtually for free to go do that, right? So if you can borrow at 25 basis points or 50 basis points and go and speculate, it really does encourage that. That's what has happened. But it has forced the mom and pop investor, the prospective retiree, to look very different at their retirement prospects. Where do you get money? Where do you get yield? Where do you get income? What are you going to do to supplement Social Security, which is not keeping up with inflation, intentionally, I might add? And it means that they are. They're looking at all kinds of things and saying, well, at least I can get 3% there. Instead of they're not considering that they're also taking on equity market risk. They're focusing on the 3% income guarantee, quote unquote guarantee, and ignoring the risk factor. But that's what makes for a wonderful, beautiful, horrendous bear market.
I agree. People are, when I speak to them, retirees or close to retirement, are desperate for income. And because we've had a bond bull market for so long, people are not used to, especially treasuries, being certificates of confiscation like they were labeled in the 70s and 1980. So we're going to have probably a paradigm shift in that respect. So I want to transition now to Carmen Reinhart. So you interviewed her a while ago. The last time we spoke, we talked about that interview at length. Do you think the economic and political elites want to hijack blockchain technology and use it to implement things like a cashless society and negative interest rates? Because I know on your podcast, McAlvany Weekly Commentary, commentary, you talk about how the academics like Ken Rogoff and others, want to ban cash. They want negative rates, especially the academic Keynesians. So wouldn't blockchain technology make it easier to accomplish that?
I do think blockchain technology, I mean, it's a ledger, and the ledger keeps track of things. And keeping track of things is what you want to do within a closed financial system. You want to eliminate people who are skirting the system, working around the system, under, over, or what have you, whether it's cash, gold. For a long time you had huge demand for large carat diamonds in China. Why? Because people wanted to get money out of China. And a 10, 15 carat stone, that does that. It does that. So, things that are opaque and private and can't be registered, folks are kind of engineering the system, aren't real keen on it. But if you have a perfect ledger, if you have the ability to track every movement of every cent, it's very handy. It's very handy indeed. And so there is something to the cryptocurrencies that, on the one hand, the crowd that loves them most, I think, has fallen in love with an asset price move and has some technological buttressing, like, this is fancy, this is neat, this is cool, and it does things that other quote-unquote currencies don't do. They're right about that. But I think what they may neglect is how something can be used by someone else or twisted in some way and used for different purposes than they ever imagined. And I do think that there are many uses for the cryptocurrencies and that technology, the blockchain technology, which may not benefit the general public. Having said that, you go to places in Eastern Europe where blockchain has been implemented for public record keeping, and it's interesting. It's actually brought greater transparency to government operations. There's some positive aspects to control of data and a perfect record of data, particularly when it comes to government transparency. What I'm suspicious of is a time-bound conclusion wherein today we like the government that we have, and they have all data on our financial movements. But what about the government of tomorrow, which might not be as benign? What if it's more malignant? And are you comfortable with people knowing everything that you do and why you do it using big data and a perfect record of all of your transactions? I think it plays a role. It plays a role in what the elites would like to accomplish. There's a presumption, and I'm not trying to be conspiratorial here when I talk about the elites or whatnot. We're talking about academic presumption that we can control the economy and continue to see things grow. There's the idea of business cycles. If you went back to theory, history, indicators, and forecasting, Victor Varnowitz's old book on business cycles, stuff like that, they're assuming that they can throw out. They're assuming that modern business cycle theory does no longer apply because we've got new tools and their monetary policy tools and their fiscal policy tools. But to get them implemented means we lose something somewhere. And then that is freedom, that is to some degree, and it is privacy to some degree. But what they're asking for is the keys to the kingdom so that they can guarantee something that is in their minds a utopia. And I don't fault them for what they're trying to do. I think it's unrealistic, and I think it comes at a cost, which I'm not particularly comfortable with. But in the end, it's this great gift to the world, the cryptocurrencies. I'm not convinced yet that they're not going to be something that we get beat over the head with.
And, their technology, and technology, in my opinion, is neither good nor bad. It's how someone wants to use the technology and for what end. So I can see the good things about Bitcoin and blockchain and cryptocurrencies, and I can also see the bad things about how, if you're an Edward Snowden or a Julian Assange, they can shut down your bank accounts and your credit cards in 5 minutes and track you everywhere. So if you speak out against look what the Chinese government is doing now with their social credit thing. So if you dissent to the Chinese government, you're not allowed to get on their trains or their airplanes anymore. And how do you make a living if you're in business if you can't do that? So.
For your listeners who've not read Juan Zarate's book Treasury's War, it's an interesting look written by a Treasury man who kind of explains how they use financial tools to wage war against other countries. And so, we're very familiar with SWIFT, the way that we have classically moved money around the world using bank wires, and they go through the SWIFT system. It's been that way since the 1970s. And yes, there's an interesting role for technology like Ripple to completely undo and redo what the SWIFT system was. But if you look at Zarate's argument and see how powerfully they can use these financial channels, either cutting off the flow or allowing credit and money to flow, it's really no different if you're talking about Ripple or some of the other cryptocurrencies, which are a vast improvement in terms of technology and speed and cost, but you still have to ask the question, how is it going to be used and who's using it? Is it towards good ends? I agree with you completely. There are so many positive aspects to the cryptocurrencies. I just want to know who's in control. Who's in control and how, what's their opinion? How can it be used? If it can be picked up like a stick and used to beat me over the head, then maybe I just decide to start wearing a helmet or something. I don't know.
And David, I have friends and also a lot of listeners to this podcast who, while the cryptocurrencies were running up, they were telling me to stop covering gold and silver, don't say anything good about it, and that they were just publicly disclosing to me that they had liquidated all their gold and silver, their physical metal, and also their gold stocks and other exposure to gold and silver entirely, and they were chasing cryptos higher, trying to get rich. So as a bullion dealer, I know you own a bullion dealing company and you also sell numismatics. Have you noticed then that a lot of your U.S. retail investors have liquidated their physical gold and silver and have been chasing crypto still? And do you think that's one of the major reasons why sentiment among U.S. retail investors is so negative now for gold and silver?
I'll be honest. We have a pretty mature client base in the sense, I know a half a dozen clients that have invested heavily in cryptocurrencies, and they have, without regret, liquidated Bitcoin at 6,000, at 8,000, at 15,000. I don't think anyone got exactly the top, but they've been liquidating all along and diversifying. And actually, we've seen some decent gold and silver purchases from those cryptocurrency liquidations. So most of the liquidations that we've seen, it's just a generational issue. 65 years old to 85 years old, and either a health issue crops up or you decide you're going to downsize, but you need to put $30,000 into the house before you sell it, and so you sell to raise some capital. We work with folks who've basically treated gold and silver as an alternative to banking, and they like the ounces, they're keeping the ounces, they sell them when they need the cash and need to spend U.S. dollars to fix stuff or pay for stuff. But I think our client base is not exactly the demographic that would have sold gold to buy cryptos. Now, I will tell you, we've had a number of clients sell gold because they can no longer bear the social pressure of showing up at the golf club, and talking to their friends who've made a killing in stocks over the last 8-9 years. And they just can't take it anymore. They know what they know about how active the central banks have been. They feel like they're beating their head against a brick wall, and to some degree they're quitting. So we have had that, but not to buy cryptos. It's more to say, look, okay, I guess I've been wrong. Stock market's gone up, and I might as well buy some. So cryptos, again, maybe it's just our demographic. Most of the folks that we know who've owned, they've been really savvy. I think of one gentleman who picked up a couple bags of junk silver. This goes back maybe 8 weeks ago, but he recognized he might not see 19,000 again, but he was still, I don't know if it was 11,000 or something at the time, but just happy,
Hopefully
to be buying physical.
hopefully set aside some money for the IRS for his tax bill, because there's stories going around now that some people got wiped out because they sold their Bitcoin and tried to get rich even quicker buying some of these tiny altcoins, and then they lost the money and they still owe the IRS a huge tax bill.
Yeah, well, that's you live and learn. There's lots of ways to get wise, and probably the chief among them is experience. Sometimes it comes hard and fast and mean and nasty. That's just the way life goes, I guess.
Yeah, so I don't think the U.S. government hates Bitcoin and cryptocurrencies. I think they see it as a new source of tax revenue. So they're not going to try to, maybe like the Bank of International Settlements hates Bitcoin and cryptocurrencies, but the U.S. regulators, they want it to grow. They see it as a new industry. They see it as a new source of tax revenue. But let's transition now to China. And then President Trump. So last two topics and questions for the interview. So I know you have a longstanding bet, or you did with your dad, Don McAlvany, who is famous in the alternative asset community, precious metals community, and you each had different views on China. So do you think China has an enormous credit bubble now? What's your opinion on that? How bad are things in China?
They have a massive credit bubble. It's just, we think of consequences to a credit bubble in sort of an Austrian sense, from boom to bust. And the bust is where you're seeing someone pay the price for the excess, and that's pretty reasonable. I would still hold to that. What you have in the command and control universe is that you can assign the losses rather than let the market dictate who is overextended and who will pay the price. So it's not clear on how their credit bubble bursts, or who the Politburo and the powers that be, who they will assign the losses to. Is it going to be to the household sector? Is it going to be the People's Bank of China that just says, look, it doesn't. We're not tied to foreigners for credit. If you look at the amount of Chinese credit in the market out there, it's virtually nothing. You look at the most recent dim sum bonds. You're not talking about a very deep market in terms of international trade for Chinese bonds. So, what do they care if their currency is suspect or their credit markets are suspect? They're kind of in a closed universe. I think there's a consequence. I think there's a massive consequence. I think that someone has to pay for the credit excess. I don't know who that's going to be, and I do suspect that the Chinese will choose the winner and loser. And that's exactly what Carmen Reinhart told us about the idea of financial repression, is that it's really just a matter of, between the academics and the policymakers, when you talk about running a negative interest rate environment, that is what you're doing. You are choosing and you're assigning the losses to a particular segment within the economy. So, negative interest rates here or in Scandinavia, it's no different than what the Chinese have in their own economy, which is a closed command and control system where you get to assign the losses. My dad's living in Asia, has for the better part of a decade, and he sees a massive shift and a massive amount of growth in the economy. Obviously, if you've got trillions of dollars being spent, doesn't matter where it's coming from, as they're spent, it shows well. It shows very, very well. The growth that he sees, I don't think, is sustainable. But, what you are doing is reconfiguring the economic landscape globally, and this is where I think we're playing almost a game of chicken. How much time is there before impact? I don't really know, but they're fighting for a bigger position in the world economic scene. The Chinese are. We already have the number one position. And is it possible that through command and control dynamics that can forestall any major credit events or assign it in such a way that they just kind of shuffle it off, almost like we did with Maiden Lane? You remember what we did with Maiden Lane 1 and 2, those special purpose vehicles where we took all the garbage from 2006 and 7 and 8, all the nasty vintage stuff, and we shoved it into a waste basket of toxic, nasty paper, and then we let all the commercial banks kind of say, look, now you've got a clean balance sheet, nothing to worry about, we'll let that stuff rot in the dustbin. That was mean lane 1 and 2. Who's to say that the Chinese don't do something similar? All that to say, look, you've got the Chinese economy and the U.S. economy, and both our leadership and theirs would like to see more dominance and a larger footprint in terms of global GDP. And can they do it through command and control dynamics better than we can through the free markets? I mean, my bet is always on the free markets, but I don't know about this game of chicken and impact. And honestly, I think now we've got additional X factors: tariffs, trade. The big deal is when technology comes into the dispute space, and we really, what has remade the modern world in the last 20 years in terms of technological innovation. Now we're going toe-to-toe with the Chinese on that front in terms of trade and tariffs. Now all bets are off. Our economy, their economy, trade war could turn from economic to something much more virulent, much more dangerous in terms of tanks and bombs and guns.
Yeah, so I would say that the U.S. doesn't really have a lot of free markets anymore. Now, obviously, if you're a small business owner, you still have to be a capitalist because there's no bailout coming. But, there's a lot of protected industries in the U.S., and they have easy access to capital with these artificially cheap interest rates. So I don't think that's really free market. And China does have an enormous amount of central planning too. I think the Chinese saver, if you're a middle class Chinese saver or a Chinese small business owner or an affluent Chinese family with a lot of savings in RMB, you're going to be the one screwed. And so we've already seen a lot of money leaking out of China, and that's where it's gone into the real estate in Toronto, Vancouver, London, United States. It's gone into stocks. It's gone into cryptocurrencies. They bought a lot of physical gold and silver. So I think the Chinese people, they have a history of paper money. Paper money, I believe, was invented in China very long time ago. I forget which dynasty. And so they have a history of, paper fiat currencies being destroyed, so they're aware of this. But you brought up the trade war. So that's something I wanted to ask you about. Do you think then that the U.S. seemed President Trump? He's been talking about this for a very long time, even before he decided he was going to run for president. While he was campaigning, he was saying he was going to do tariffs, he was going to do a trade war, he was going to escalate things. So as I don't like President Trump on a lot of things. Some things I like him, some things I don't. But in this particular case, it was scaring the crap out of me. So what are your views then? Do you think the U.S. can actually win a trade war, or do you think that really no one's going to win a trade war?
Well, I think one of the things that it seems to be missing from Trump's economic advisors' calculus is that if you go about reducing the trade deficit, you're also reducing trade surpluses elsewhere in the world. It's those trade surpluses which have gone a long way towards subsidizing our budget deficit. So now, like we talked about in the early part of our conversation, if we're going to log $1 to $1.2 trillion budget deficits, and at the same time shrink the audience or shrink the funding mechanism, trade surplus dollars being recycled back into U.S. Treasuries to support our budget deficit, you could actually have a blowout, just a massive blowout in terms of the budget deficit, as we don't have anybody to fund it. Who's buying? So I think his trade deficit objective is at odds with a stable U.S. currency. It's at odds with being able to wrap your arms around the financing of our budget deficit. So I don't know what he's thinking. I really don't. I think that what he's done good is reduce a lot of red tape, and so look, I think that's probably where I think he's shown best is with reducing governmental red tape. I don't get the sense that his quasi supply side. Now we've got Kudlow coming in to tell us how we can have like supply side economics on steroids, and that's going to help us. And as you said, if you reduce spending commensurate with a decrease in taxes, that's one thing. But we were able to run a budget deficit during the Reagan administration because our debt to GDP figures were less than 35%. and now we've got better than 105% debt to GDP figures, and you don't think there's going to be a negative consequence or some unforeseen consequence when you start running massive budget deficits, but your debt to GDP figures are already sky high? We had greater latitude. If you take the one great test case for supply-side economics, we had greater latitude at 35% debt to GDP. We don't have that latitude today, and I just don't get it. So, yes, great, 2 thumbs up in terms of reducing red tape. I think that's ultimately very good for the U.S. economy. But in terms of him understanding finance and trade, I'll be honest, I'm not real encouraged by the Kudlow-Ross team.
A lot of people think that Trump, with the trade war retaliation, he will continue to escalate things because he just wants China to renegotiate a more fair trade deal. So he doesn't want to bankrupt China necessarily. He just wants to bring them back to the table and agree to a new type of trade deal. So we'll see if that happens. But I mean, a lot of these trade deals that have happened with now these I did a short video on this, David. So a lot of these trade deals that were labeled free trade were free trade in name only. As long as these governments like China and so many others are going to do either currency devaluations or currency pegs or taxing imports heavily, that's not free trade. So that's different versions of mercantilism.
Yeah, no, I think that you're right on getting us a better deal, and he's already proven to do that in many respects. And I do like the fact that he's my way or the highway negotiator. It's going to move the needle for us in terms of getting a better deal. If I were doing that and trying to renegotiate trade deals, I don't think I'd have as my chief objective reducing the trade deficit by $100 billion or more. I'm not sure that that's where you go. I think actually that creates more problems than not. Renegotiating the trade deal is great, but eliminating the trade deficit or reducing it considerably creates other headaches for a budget deficit we can't afford. We don't have a solution for.
Agreed. And even if the U.S., and I'm using air quotes, wins a trade war, right, and we do get a renegotiation, and China acknowledges U.S. corporations' intellectual property or things along those lines. I mean, there's going to be, with this escalation, we've seen the Chinese announce this whole amount of tariffs in the many billions. There's going to be a lot of collateral damage in the U.S. So if the U.S. does, and I'm using air quotes again, win a trade war, it's not going to benefit every single American citizen or American worker or American saver equally. There's going to be certain workers in certain industries or certain business owners who are going to get potentially crippled or bankrupted by this trade war then.
Yeah, I mean, it's going to be interesting to see how the market responds to all of this, because what the market needs is a clear path towards normalcy, a clear path towards growth, a clear path towards peace, and whether it is what we spoke of earlier in terms of a tightening of credit or a slowing down of a transfer of funds from one country to the next. Open borders, open markets in terms of cash, currency, and goods, that's great. That's great for the markets. That is great for asset prices. And if trade becomes a real issue to gum that up, or if liquidity in the credit markets becomes an issue to gum it up, we're way out over our skis in terms of the asset prices that we see in the stock and bond market today. You get a lot of downside from here. 5-10% off of all-time highs. Hardly a healthy correction in my opinion. We've got a lot more ahead of us, assuming we continue to see a tightening in credit and chaos on the trade front.
So before 2018 started, I thought one of the major themes for the year would be volatility was returning. It was going to get a lot worse. We were going to see it pretty pervasive in a lot of different asset classes. Do you think that's going to be one of the major themes, or do you see another major theme for 2018 that you're pretty confident in?
I like the return in volatility. It suggests that the markets still have a pulse. And it's not just a question of sort of a lifeless body in a hospital bed, getting its oxygen feed and an IV drip, which the markets were starting to look like that. It was just like, there's no real players here. What's happening? So I do like the return of volatility. I do like the difference of opinion. I do like the articulation of the bull and bear case, the conflict, and ultimately I think we see an erosion and a break in the markets. The other things that I think are pretty clear is we're getting very close to a major wave higher in gold, and we have ridiculously negative sentiment here in the United States. So I'm not predicating this on sort of subterranean purchases of U.S. investors who are taking things off. But nobody in the market cares. Nobody here in the U.S. cares about gold and silver today. I would say this was more acute 3 months ago, as the imagination of the investing public was captured by the cryptocurrencies, but certainly 26,000 Dow and Amazon and Google and Netflix and Tesla, capturing the imagination. 2, 3, 4 weeks ago, it was still different. Very bullish on all of those issues. And I think one of the things that's going to propel gold higher is something of a market correction in stocks, and seeing this long-term trend shift in fixed income is also significant, because the classic rotation from stocks to bonds for safety may get skipped, and we may see a lot more dollars flow from stocks right past the bond market, afraid of rising interest rates, and into sort of a neutral, either cash position or gold. And I think that from a technical perspective, gold is looking good. I'll tell you, I thought it was looking good probably 3 or 4 other times in the last 6 years, and I look like an idiot having thought that 1650, 1430, or I could give you the other chart points, but we blew through those numbers on the downside, unfortunately. But I do think we've got the last leg of a bull market in gold, and we're dealing with a confidence game whose scope is international. We're dealing with the general publics of Europe and of Asia and of America and the rest of the world who have counted on the PhDs, the economists who've been running the show for the last 8 years to continue on. And if there's any challenges to their credibility, we're going to see some very different dynamics. Again, instead of there being the rotation from stocks to bonds, I think you see people looking for alternative assets, and I think gold catches a bit of a fever. There is no fever like gold fever. We've been in the business for 46 years, and we've provided IRA resources to thousands and thousands and thousands of clients, physical delivery for folks all over the world. We've launched innovative products overseas and in Canada. We've got a phenomenal product that we're just launching with the Royal Canadian Mint. And, people have no interest in gold today, but you asked what I thought were some definitive trends. I think one of the definitive trends for 2018, probably through 2022, is the last leg of a gold bull market. And I think this will be one for the history books.
There's actually a lot of professional money managers who have made money in stocks and bonds and real estate and the other major asset classes for the Fed and other central bank reflation since 2008 and 9. They've been rotating into gold the last year or two. So they've been, steadily accumulating into gold because it's cheap compared to everything else. I mean, there's not a lot of bargains out there. It's like we discussed earlier in the interview, though, it's the U.S. American retail crowd that has totally given up on that. So the sentiment is just incredibly negative. But when I look on the supply side for gold and silver, when I speak to, as I speak to a lot of people in the mining industry, the mining industry can't really cut any more costs. So maybe we go down a little bit more in the short term, and that's like the final wipeout stage, but then that's just more bullish because even more supply will come offline. So we're around those stages now, David, where a lot of these primary silver miners, they can't make margin anymore. They're buying gold mines. There's a lot of primary silver miners now that have been mining silver for over 100 years, and they're getting out of the silver business. So as a contrarian, that actually interests me. Although, in the short term, anything can happen. In the long term, though, that's actually good for the bull market, like you said.
Well, and I think for anyone who's interested in the metals, silver at 80 to 1, it's more than that now, but I would say anywhere from 80 to 100 to 1 compared to gold, that is ounces of silver to 1 ounce of gold. It's I think it's a bargain, and I would own it. If you're the guy who wants instant profits, a la Bitcoin going up 30% per month, you'll be disappointed. But I do think that over a 3 to 5 to 7 year period, you could see silver trade to $100 or $150, and off of its current $15 to $18 range. Is that worth having a few dollars in? Yeah, I think so. Back up the truck with 100% of your assets? No, but you should own it. If you're seeking value, as you said, there's very few places where you can find value, and that is one of them, gold and silver.
And the other thing about silver is, besides the gold to silver ratio, which you pointed out, which shows that silver is a bargain compared to gold, is that silver is like trading right around its production cost. So there's not much margin there. So maybe in the short term it can go a little bit lower, and temporarily the silver could go maybe below the production cost of some of the primary silver miners, although there's a lot of silver byproduct I've highlighted from copper and other base metal miners, but that's not sustainable. So there's going to have to be a rebalancing in the market, and I already said that there's not a lot of investment going into primary silver mines. In fact, the primary silver miners that have primary silver mines are trying to get out of the business. So I think, at market bottom, when the market bottoms and sentiment starts to reverse and the bull market restarts, you do see examples of extreme negative sentiment, and I think that's the case here with silver. But I want to thank you for your time today, David. We've gone over the time limit. You're a friend, though, and a mentor, so I enjoy speaking to you and learning from you. And if our listeners want to subscribe to the McAlvany Weekly Commentary, talk about that and also some of your companies.
Yeah, so the weekly commentary is a free service. We've been doing it for over a decade now. As of March, we passed our 10-year mark, so 500 and I don't know how many episodes. But join us every Wednesday at McAlvanyWeeklyCommentary.com, and you can tune in if you want to subscribe. We'll shoot you an email, usually Tuesday at midnight, and you can be the first to listen. That's sort of our, ongoing educational piece. Been in the precious metals business for 46 years, and in the money management business, which kind of gives us a foot in both worlds: traditional asset management and alternative asset management. So we tend to see traditional assets from a somewhat unconventional viewpoint. I mean, so that's one of the reasons why in recent years we launched our tactical short with Doug Noland, who's been writing the Credit Bubble Bulletin for decades now, and one of the best credit analysts alive today. So we see some opportunities on the short side. We see some opportunities, obviously, on the long side, but do feel like who we are as a group is unique within the financial universe. And if you're looking for someone who's been around a while, operates with integrity, has an amazing team, fabulous people. I mean, the joy of working here is amazing. I can't believe that there's actually compensation involved, because we have such a great crew, and it's a joy to be working with them. But if you feel like you want to talk to somebody who knows these markets, pick up the phone. McAlvany.com is a great way to find us online. 800-525-9556 if you want to speak with a live voice. So again, 525-9556, and that's what I would say.
Hey, Wall Street from Main Street fans. It's Mike the producer. You want to get 40% off Noe Prin's latest book, Collusion? How Central Bankers Rigged the World? Well, you need to use our link at 800ceoread.com/Wall Street. That's 800-CEO-READ.com/Wall Street for 40% off Nomi Prin's latest book, Collusion, How Central Bankers Rig the World.
Great. Well, I want to thank you again for your time, David. And our listeners, if they're looking for an interesting, inspirational self-help book, they should definitely check out your new book as well. And keep up the great work on the McAlvany Weekly Commentary.
Thank you, sir. Great to be back with you.
Please like this video, share it with friends and family, and don't forget to subscribe to the Wall Street from Main Street YouTube channel if you have not already done so. We're closing in on the 20,000 YouTube channel subscriber milestone, despite YouTube censorship. And hopefully we'll be able to get to 30,000 or even 40,000 YouTube channel subscribers quickly if YouTube doesn't shut down the channel. If YouTube does shut down this channel, remember to also sign up for the Wall Street from Main Street email list that's on the wallstreetfrommainstreet.com website and will tell you where the videos are going to be uploaded instead of YouTube. Also, if you really like the content and you decide that you want to give a one-time donation, you can go to the wallstreetfrommainstreet.com website where there's different options for you to do so. Or you can become a Patreon contributor. Thanks for listening, and I look forward to providing you guys with some of the best information, analysis, and financial education available out there for free or paid.